Reserve Bank Governor Jill Marcus made it clear that the country is in a rate hiking cycle, but that it didn't mean rates would go up every 2 months when the MPC meets. The bank remains concerned about inflation pressures emanating from a historically weaker rand.
Since the previous meeting of the Monetary Policy Committee, inflation has breached the upper end of the target band and is expected to remain outside the target for some time.
Meanwhile, consumers are being warned not to take the rate unchanged decision as a trigger to borrow more money.
We just don't know when the next rate hike is going to be. But she's signaling forward to consumers to say that you need to tighten your belt. The problem we have is not interest rates per se, but the fact that we are very highly indebted. A lot of our income goes towards servicing debt. We save very little. Even current consumption is financed from credit.
Of concern was the bank's downgrading of its growth forecast for the economy for 2014 from 2.6% at its last meeting to 2.1% now.
Unfortunately, as things stand, there's very little evidence suggesting that South Africa is taking advantage from an export perspective of better global growth and a weaker exchange rate, going by the labour unrest we've had in our main exporting sector, and also by the fact that there are other supply-side constraints, for example, on the electricity sector.
The bank reiterated that it alone could not be responsible for getting the economy back on track, with Marcus adding that the National Development Plan blueprint awaits all the relevant actors, including the new government, to implement it. Nompumelelo Siziba, SABC News, Johannesburg.